Good evening and welcome to your weekly market wrap. I'm Daniel, bringing you the top financial headlines and investment insights for the week ending July 24, 2026. We start with a major corporate milestone. British American Tobacco Kenya has posted a record half-year net profit of just over 3 billion Kenyan shillings. This marks the first time the company has crossed the 3 billion shilling mark at the half-year stage. Net revenue rose by 4.6% to 12.27 billion shillings. What's driving this growth? A strong uptick of their oral nicotine pouches, launched just last year, coupled with a recovery in export sales. However, it wasn't entirely smooth sailing. The company faced headwinds from consumer downtrading and heavy illicit trade pressure, which now accounts for an estimated 45% of the total cigarette market. Despite higher operating costs, the board is rewarding shareholders, maintaining an interim dividend of 10 shillings per share, payable on September 25th. Moving over to the debt markets, and the Central Bank of Kenya is cashing in on strong domestic demand. The CBK raised a massive 63.3 billion shillings from its July 22 bond auction. This was a 215% oversubscription, with investors bidding 85.9 billion shillings against a 40 billion shilling offer. The auction primarily featured reopened 20-year and 25-year bonds. Investors heavily favored the longer 25-year paper, which priced above par. This is now the second consecutive heavily oversubscribed auction of the current financial year, with the CBK front-loading its issuance while investor appetite remains strong. Over at the Nairobi Securities Exchange, it was a sea of green. The NASI 20-share index gained 101 basis points to close at 3,997.50. The all-share index rose by 82 basis points, and the NASI 25-share index climbed 86 basis points. This positive local momentum was mirrored by the MSCI Emerging Frontier Markets Index, which also ticked up by 40 basis points. In the money markets, Treasury bills saw an overall subscription rate of 137%. Demand was heavily skewed towards the 91-day paper, which saw an impressive subscription rate of 275%. Yields closed relatively stable, with the 91-day at 8.78%, the 182-day at 8.95%, and the 364-day paper at 9.04%. Now, for our stock recommendation of the week, we are looking at CIC Insurance Group, and our verdict is to hold. Here is why. The stock currently trades at a rich price-to-earnings ratio of 22, which is well above the sector median. The company posted its first underwriting loss of 176 million shillings in FY 2025, then faces lingering risks from election-related claims, such as the 134 million shilling Naivas claim from last year's protests. On the plus side, CIC recently raised 1.8 billion shillings from land sales, using the bulk of it to pay down a cooperative bank loan and save around 180 million shillings annually in interest costs. Our advice: hold your position. Keep a close eye on their half-year 2026 results coming out on August 28. That report will show the true impact of their debt reduction and tell us if the stock is truly worth its current premium. Before we go, a quick reminder that investing in Kenyan government bonds is now simpler than ever. Subscribe to be in the team.